Welcome everybody. It's Jo Vadillo here for Property Women, and thank you for joining the lunchtime webinar. And we're talking to Tracy Kearey from Home Loan Connexion. Hey Tracy.
Hi Jo, thank you for having me.
Absolute pleasure, and thank you for dedicating some time to get grilled.
Oh, yeah, thanks. Thanks. I'm not feeling that at all.
Look, I just think it's a really good time now to be speaking about finance, because a lot's gone on in the last couple of years. Mm-hmm. And I know we've had a lot of people, since I've promoted the fact that you're going to be here, there's some really interesting questions that are coming in, like to the point where I'm like, oh, I've never actually thought of that. So I will save the Q&A to the back end. And if anyone else has any further questions they'd like to ask of us, it's in the chat as well. So just jump in and ask your questions as well. And that if you want to remain confidential, that's absolutely fine. It's what we're really hoping to do is educate, and also, I guess, open the doors to maybe some ideas about how you can structure your finance so that when you do go to borrow, whether that be in 6 months or 18 months, your structure and I guess your finances are set up well and right as well. So TK, I'm going to read your bio out now.
Okay.
It's almost like when someone sings happy birthday to you, you stand there and you go like, oh, what am I meant to do? So if those of you who don't know Tracy's been speaking for Property Women at our events for a decade, possibly.
Yes.
And you've looked after a lot of our community members as well, and your career has spanned 20 years in the broking industry, finance and mortgage broker, and you've helped thousands of people fulfill their dreams of getting property as well. So highly experienced in securing loans for resi and also investments. And you've got an access to a panel of over 45 lenders.
Mm-hmm. Yes,
yeah, provide clients with a vast range of choices, which is, I think a lot of people don't recognise that, and I do speak from a property buyer perspective to clients that kind of go, well, I just went to St. George because I opened an account with them when I was 15, without realising that there's a vast amount of lenders out there. And obviously you understand the financial challenges that are faced by young people just trying to, get back on the market. Sometimes that's after divorce as well, and it's just... Yeah. Getting back on the property wagon, so to speak. And one of your things I know you do love is also educating and kind of demystifying that borrowing process. So with that, could you demystify what's going on now that APRA, for those of you who don't know, APRA had sort of what the best way to describe it, tightened the reins on lending. Do you want to take the, would like
yes.
to?
Okay, I will. So thank you, Jo. And yes, lending is a very much a passion of mine. Obviously, it's my livelihood and my business, but I am very interested in consumer outcomes and making sure that we, provide them for our clients. So being in the industry for over 21 years, seen lots of change, as like with any industry. Lending's been quite interesting. It has gone through some massive changes from when I first came in as to what you can do today. During those changes, though, some have been positive, some not so positive. APRA came out a couple of years ago, and with investment lending in particular, banks had to have a cap. So, excuse me, they couldn't, their book had to be only 10%. So whatever their book was worth, if their book was $1 million, they could only have $100,000 in investment lending, just to simplify it. So they made caps on investment lending at 10% as the total book because of risk. And because the market was going too fast, they were trying to slow the market down, because the government, I guess, APRA, they were all thinking, well, how are people going to be able to afford a property? And a lot of first home buyers, because they were being put out of the market. So that, this was one of their, let's try and bring the market back and slow it down a little bit so it's more obtainable for the wider community. So that was one barrier that they brought in. And then they made a lot of changes around interest-only lending, which personally I don't think that's always a negative, because some people do want to own their home. So it really depends on why you want interest only. So interest only lending was changed massively. Some banks even today won't do interest only for owner occupied debt unless there's a very good mitigants or reason. But they will do interest only for investors. Some of our lenders completely got out of the investment space because they had already hit their cap, but now they've come back in. APRA have now, reduced that, so the 10% cap is lifted. So now banks can open the doors, so to speak, for investment lending. Some lenders that will lend to investors will only lend to 80% on an investment property. and interest only. Whereas now we've seen some other lenders come back into the market going, we're okay to go to 90%. So that really comes back to the individual lender's book and where their risk is at and where their appetite is at.
Yeah, okay. So you said like it's say a million, 100,000 of that is for investment activity. What's normal? What would be, how do most lenders split their resi investment?
Well, as I said, it obviously they were heavily weighted, and some lenders more so were heavily weighted in the investment space. Like Westpac, for example, and I'll use them as one example, they did a lot of foreign investment lending. So they did a lot of foreign investment lending, so that meant they had a very big, heavily weighted book on investment.
Oh, okay.
So when the changes came in and foreign investment lending tightened up, a lot of Westpac are not in that space anymore.
Okay.
So, it's about the risk of their book, because obviously if it's too heavy investment, it's all about risk. Because then they have to sell that money to be able to, invest it so people can invest in their business to lend more money out.
Yeah, gotcha. Okay, so now APRA has announced that they're making things a little more relaxed.
Yes.
Does that
Good word.
Does that make it easier for people like myself to get loans?
Okay, now once again, yes, APRA have reduced the floor rate. So what we mean by that is when you would go to a lender up until about 6 weeks ago, they would assess all your lending, whether you're paying 1%, 3%, 4%, they would assess any existing home loan lending at anywhere between 7 and 8%. With the relaxed changes, APRA have come out saying you can reduce that floor rate. So now majority of lenders are anywhere between 5.5% and 5.75%. So if you're going to a lender and you're borrowing $500,000 with them, that loan will be assessed at whatever their floor rate is over the 30-year period on principal and interest. If it's an interest-only loan and you've got 5 years interest only, then the loan is assessed at 25 years principal and interest at that floor rate.
Right, okay.
Okay, because a loan term is 30 years.
Yeah.
So if you have interest only for 5 or 2 years or 1 year, then the balance of the loan, because it's a 30-year loan term, the principal and interest repayments are calculated over that.
Mm-hmm.
So having interest only can impact on your borrowing capacity, definitely, because they're assessing your loan over 25 years, not the full 30 if it's principal and interest.
Sure. From a monetary, like from a dollar point for that $500,000 loan, at the top of your head, what would be the difference?
I knew you were going to ask me that.
What would be the difference now compared to the floor rate being 7+%?
Well, this is where it gets interesting again. You mean in terms of what are they calculating the repayment to be?
Oh, it's just, so I've asked the question incorrectly. Okay, just say I want, what am I trying to ask?
Okay, so $500,000. If we were to say we're getting a rate of, I'm just going to use 3.7, and it's an investment, right? So we've borrowed $500,000 and we're borrowing that at 3.7%. The interest on that loan is $1,541 a month.
Okay.
Okay, so if you've got your $500,000 and you're borrowing that over a 30-year period on a straight principal and interest loan at 3.7%, and this is investment rate.
Yeah.
So 3.7, 500 over 30 years. Sorry, I'll go back at 5.5 at the floor rate. The repayment is $2,838 a month.
Right.
Okay, so that is what they would assess your loan at over 30 years on a principal and interest loan. If you took that same loan over 30 years, they're now assessing it at $3,070 a month.
Wow. So you've got to have,
so it's approximately,
you've got to be able to prove you've got evidence to be able to sustain.
Correct.
Yeah.
So a lot of people are under the assumption that, oh, I'm taking interest only, so my repayments are lower, I should service more. But it actually works in the reverse.
Oh, wow. Okay, yeah, that's interesting. I didn't actually,
right?
Yeah, I've never
thought about it that way.
Yeah, looked at it like that as well.
Correct. So sometimes with a client, I might have a client that wants an investment loan and they want interest only. They may only be able to qualify for 1 or 2 years interest only.
Oh, wow, okay.
But it depends on their strategy. It depends on how long they're holding the property. Why do they want interest only? They may want it for 1 or 2 years because they're in the process of building their portfolio, and in 2 years' time they want to start paying off the property to own it, or it may be only a hold for 2 years.
Yeah.
Or it may be a property that in 2 years' time they're going to downsize, and that's going to be the property they're going to move into. So, you know, you need to understand the strategy sometimes before you work out how long do we want the interest-only period for.
Yeah, of course, of course. And do you find now that people are coming to you with, I guess, people who have had a loan and it was interest only, and now they wanted to do the refinance, refinance to get back into another interest only period with another lender?
Yes, because years ago lenders used to extend after the first 5 years. That's kind of been not as much. They don't offer it as much. So recently, until these floor rates have changed, it was more difficult because the assessment rates were so much higher, people couldn't move. So they were stuck paying the principal and interest loan. And like I said, it depends on your strategy. Some people did want to still remain interest only. And even though the client was meeting those repayments and paying them, but when you put it in the calculator, because the floor rate was higher, you couldn't service. Some people couldn't service what they had in the calculators. Now with these changes, yes, it's potentially allowing people to maybe borrow a bit more money. And I'm not saying that you should go and borrow your maximum amount. But if you've got an ideal property, 6 weeks ago, you might not have been able to borrow, say, an extra $20,000 or $30,000 or $40,000. Some calculators are allowing people to borrow more, and there is a lot of questions that go behind that calculator to understand why. If you've got a lot of investment debt, there are different lenders that calculate, you know, 80% of the rent, right? They'll take, then they add all the expenses in. So you've really got to understand what's the lender's policy around what income they will use and what expenses they'll use. Some of our lenders, they just take the income, the rental income, and they'll take it at anywhere between 65 and 80%. The exact expenses that you've got, and it may be you have one property and it costs you $400 a month to hold. And what I mean hold, that's the rates. It might be the rates and insurances, and the client, the rental, pays the water and etc. But others will look at we've just found recently, we'll look at the tax return, and if you've got a lot more expenses, you know, like it just comes back to the individual lender. Yeah. So like you said earlier, you may have banked at St. George forever and no problem with St. George, but today they may not be the lender for you. Yeah,
sure. And is there logic in spreading the portfolio across a number of different lenders?
Yes, look, I guess short answer is yes. Some people stay with the same lender because obviously it can be a bit more convenient, but you know, we do have a lot of clients at the moment that have one loan over with lender A and want to use equity out of that to buy with lender B for asset protection. Because when you have lending with one lender, yes, you can potentially get better rates and better deals because you've got so much lending with them. So, aggregate borrowings. And we can make I recommend to a lot of my clients to have standalone properties. So one property with that loan, this property with that loan.
Not cross-collateralized.
I'm not a massive fan of cross-collateralized. However, once again, it comes back on the strategy. So if you're own a property right now, and let's say it's worth $500,000 and you owe, in a perfect world, $300,000. You came to me and said, I want to borrow extra money to buy property B, but this one I'm keeping, the first one I'm selling in 6 months or whatever, we're releasing it, that would be okay. But if you're thinking you're going to buy and sell at all different times, definitely standalone is better, because when you have all your properties crossed and you say to the bank, I want to release property B, they will value all the other properties. Now, if your valuations have gone down, they would retain more of your funds from that settlement.
Right, okay.
To keep your LVR at 80% or whatever your original LVR was.
Yeah, okay.
Oh, LVR, ladies, and I'm sure you all know, is loan to value ratio. And men, for any that are listening.
Yeah, we get
loan to value ratio.
Yeah. So the easiest way to explain cross-collateralization is that the lender holds one property accountable for the performance of another.
Yes.
Yeah.
Correct. And and you could have, say, one loan. Let's say all of your lending's investment. You may just have one loan of $1 million again for the whole 4 properties, and there's one loan and all the properties are holding that money.
Yeah. Okay.
Securing that $1 million. So if you sold one property, you'd need to pay that down to with 80% of what the remaining value is.
Yeah, wow. And that's pretty risky.
It can be. Like I said, it comes back to strategy and what you're doing. So everybody's got a different strategy around it. So I've had clients that crossing worked because of the purpose of what they were doing.
Okay.
And I've had other clients where we go, you know what, we need them all standalone because we know you're going to sell that in 12 months or 2 years, but you're going to retain the rest.
Yeah, understand. Okay, so I did say that you'd be talking to us about what can you do now if you're looking to borrow, say, early 2020, like just say I've been in a new role for the last 6 months, so I've got, six months of rungs on the ladder. What should I be? Should I be cautious? What's going on a credit card?
Yes.
What are the red flags?
Okay. So with employment, different lenders once again have different policies. If you've been in the same industry previously and you're now on a probation, some lenders negate that because you've got history. Majority of lenders, if you've been there 6 to 12 months, same industry, that's fine. So your employment's fine. So what really lenders look for is stability. How long have I been in my job? How long was I in my previous job? If you've recently changed jobs like 6 months, you could have been headhunted. Well, I was here, but I'm now here because I'm earning more money and it's a step up in my career. So employment history, where you live is also, like the longer you live in your address, if you're a renter, and sometimes it's not that easy because the people sell. But, longevity, lenders like that because it shows that you're a low risk. Stable, exactly. And they like that. They like, stability and, conservatism, I guess you could use that word. In terms of living expenses and personal debt, that is massively under scrutiny. So we're finding non-disclosure of debt is an issue where straight away you can get a decline. For instance, if anyone out there has a zip pay or an afterpay, I think they're the main ones that they offer. You can go to Q today and I can buy my clothes and pay for them later. Now, for some of us who are a bit older, lay-by was what we used to call it, but you'd leave it at the shop. But now you can take it with you, right? That is a debt.
Yeah, of course.
And if you don't disclose that and the bank see it and I'm not aware of it, or, we check your bank statements, we will check your bank statements to pick those things up. We're not looking for people to say, oh, we caught you out. We need to know so that when we're going to the bank, we go, yes, we have this debt. It's 4 payments normally, but we still need to disclose it. Because the bank don't know that you're not going to go back there next week and do another one. Yeah. So really be aware of what your spending habits are. There's been a lot in the media about Uber Eats. So, if you're spending $30 a day on Uber Eats, that's a living expense.
Yeah.
So over a week, that's $210 a week, that you're spending on a takeaway.
Yeah.
Now that's over $10,500 a year. So that is in your income, that is in your expense. It's all these little sort of lifestyle that we have.
Well, the same would apply to smokers. I mean, I think smoking cigarettes are $30 plus.
Correct.
Yeah. So
and
that is a health risk as well.
Well, look, we haven't gone to that yet, but they're obviously some of the lenders have brought out we have to look at people to make sure they're not being financially abused. So there's a lot more compliance around this. We're not psychologists. When I say we as brokers, some lenders want us to tick to see if there was any financial hardship. I would like to think no, and I would like to think that if I had a client in that situation, I would be aware of it, but you don't know. Yeah. Right? We're not doctors, we're not their psychiatrists, but I guess that's another conversation maybe for another day. But just be really mindful of your spending habits. And we look at it over a 3-month period.
I was going to ask, is it 90 days to stop?
Yes, and normally in that 3-month period, look, over Christmas, people's spending habits go up and they go on holidays and they spend more money, but that's not happening every day. So if we were doing an application over an Easter or you went away, we mitigate it. We say, look, the client's been away for 3 months, so their living expenses were here. Or, yes, they went and bought a large screen TV, but they're not going to do that tomorrow.
Yeah.
So there's discretionary expenses and there's, expenses that we have to have, like feeding ourselves, clothing ourselves, all that. So we can mitigate that. And we just really, when you're talking to your broker, and I'd like to think we're all using brokers out there, you just disclose everything.
Yeah, right.
Because then we can sit down and say, well, you know what, I did have this expense, but it was for this. You're not going to be going buy a TV every day of the week. So it's really just some common sense and full disclosure.
What if, I'm not a cash carrier, or rarely.
Same.
So I pay wave everything. So I've got a well-documented history of what I'm spending my money on. But what if I did get $600 out of the bank once a week and that was what I did everything with, and now there's no history to say.
Well, that's so big. What we would do then is the client. So that does make it a little bit difficult in some respects. But the client, in our fact finding, they fill out their living expenses, what they believe they're to be. So if you're taking out $600 a week, we could then apportion that and say, well, look, it's $200 for food, or I don't know, $150 for food, $50 is for my transport, $100 is for my entertainment. So you'd break it down. Yeah. In some respects, it does depend on your spending habits. And we do have tools that scrape the data. So we use in our business, it's called Rely Check. So we would say to the client, you upload, the bank statements get uploaded to a portal, and it scrapes all the data and it puts everything in buckets. So my food for the month, my electricity, say, for the month, my rates, my shopping, I went to the hairdressers, whatever it may be. And then it puts in your expenses to say, well, these are expenses that are everyday expenses, but these are discretionary. And then we can write notes around it. And we can say, well, like I said, they bought the big TV, or they went on the overseas holiday. So, it's not spending habits every day. We've got the daily habits, but we can mitigate what is a daily habit and what is something that might be a one-off.
Yeah, wow. Okay. I didn't know at what point it became Big Brother, in that, geez, you go to Dan Murphy's too much on Friday afternoon.
Oh no, we do get some of those questions, like yes, and if you're at say somewhere where there's gambling, and like I like to around cup time. It's so interesting around the Spring Carnival. So around Spring Carnival, a lot of us all go and have a flutter on the horses. It's a thing we do, but it's not something I do every day. It might be just occasional. Yeah. So these are the things. But you're right, we have had some credit officers, and because it's been a lot of change, they're obviously under massive scrutiny themselves. So they want to make sure they're doing it right. But we've had them come back and query some of the most absurd expenses, like someone in their 50s with a baby bunting. Are they having a baby? It's the grandchild, or just something like that. But they'll pick sometimes something very obscure. So we, as in terms of my business and as a broker, what we need, we get the bank statements and look at it, because we want to make sure that when we're presenting the application to the bank, we have got all the answers.
Yeah.
So as for us, we do a lot more research and a lot more work up front. Mm. And if a client came to me and said, oh, look, I'm a bit concerned, I went out and did this and did that, no problem. We just look at it and work out how do we mitigate it.
Yeah. And I imagine when you've got a lot of stuff on and you've got, a couple of kids at home, and like you can forget you've got a $5,000 credit card in your top drawer. Like, I know that sounds crazy, but it's like sometimes, when I've gone to get loans, I think I've declared everything. You're like, oh, I forgot when I got that mortgage, I got a credit card at the same time. And it's kind of like, the just in case credit card.
Yes.
But I know that $5,000, even though it might not be tapped into, that would also affect my credit ability to borrow, I should say.
It does, because it's on the limit. And so now with comprehensive credit reporting, the banks have opened it up so everybody can see everything, with some of the major lenders predominantly. But now, like we had, one of my brokers had an application go to a bank. They went back to 2014 and wanted to know what all the credit inquiries were for.
Ooh.
Because right now they didn't have that debt. Because, I don't know, but I borrowed money in 2014. Might not have that debt now. And you're also right. Sometimes we have a credit card that we've had for 20 years, never use it.
Yeah.
But with the credit reports, they just go back, and it could be that, look, non-disclosure, we need to be on top of our game. And if somebody's not sure, if I had a client say, look, I'm not sure, I think I closed it, we can always do a credit report ourselves in our business and have a look at what it's showing and say, well, look, this is what we've got. We've got listed, 4 credit cards. Do you still have them, or are they closed? And we just, do that, a bit more research on it.
Wow. So I guess there would have been a time when people could have done sneakies and it wouldn't have been as traceable. But now
everything's full disclosure. And, there were some lenders, even up until 2 years ago, where if you had a credit card that you paid out every month, they didn't put that into your servicing.
Yeah.
Because it was like, hey, you're paying it out, but that's all gone. Like, it's all, anything that's got a limit, even if you say, I never use it, still got to be disclosed. So, if you've got a lot of credit card, or not a lot, if you've got some credit cards and you're not using them and you're looking at borrowing more money or getting into your first property, definitely have a look at what you don't need and cancel it, shut it down, get rid of it, cut it up, as they say. If you've got a personal loan that's only got a few payments to go on it, yes, it's great to have savings. You need to have equity. But if you've got some consumer debt and it's higher interest rates, really try and concentrate on getting rid of those debts and just cancelling them altogether, because you'll be paying a lot of interest on them as well.
Sure. And what about babies? So, I've worked with a couple of clients that have got 1.5 children. You mentioned grunting. I guess you have to highlight, if you are pregnant, you need to mention you're going to have another.
Yes.
It's not a liability. What's the word?
Dependent.
Yes,
and it's very interesting because when we sit in front of the clients, we ask we have to obviously do our due diligence. Is there anything that may change your income to pay this loan in the future? Are there any changes to your income? And sometimes you can visibly see that a female's pregnant. Sometimes you can't. You might think they are. You can't assume. Okay, very big lesson I've learnt over the years. You can't assume. So, if someone is having we ask those questions. Oh, I'm pregnant. Okay, so are you going on maternity leave? If they're going on maternity leave, there are lenders that will look at using the income during maternity leave, and then we need a return to date. But you do have to disclose that baby that's going to be born as a dependent. So if you've got 1.5, as you've said, you've now got 2.
Right. And what is there, like a percentage impact that will take? It depends.
Do you know what, Joe? I know every lender has different living expenses. As once again, living expenses are the number one that banks are all over at the moment. Some are using HEMS, some aren't. Some are, normally the situation is if my client spends more than their living expenses that they allow, they'll use the higher of the 2.
Yeah.
If my client is under HEM, under the bank's living expenses, they'll use the bank's one, and we've got to mitigate it. And some people spend less than other people, regardless of what they earn. Some people are very frugal. Some cultures spend differently. And even though they might earn the same money as you and I, they just don't spend. I mean, we've all got our, like I call it, I like shoes. I like, clothes. I like getting my hair done. It's not for everybody.
Of course.
So, it's always the higher of the 2 in terms of the living expenses.
Wow. Okay. So my next question then is, we had a really busy, popular webinar last week around multi-occupancies.
Yes.
Lots of interest in this space. And in fact, I'm actually presenting tonight in Sydney. I'm doing a presentation because they're changing some legislation in New South Wales and allowing people to potentially sublet their house more, like they basically chop up their yard more and make it easier for people to do so. So I'm on a little bit of a learning trajectory in that myself because of these quite new changes. So in light of that, with multi-occupancies, and specific to what we talked about in the webinar last week, when you get a 5-bedroom house with 5 en suites, and your intention is to have 5 separate tenancies, I'm trying to think how I word this. It flags as a commercial enterprise, doesn't it, with the lender?
With some. So I've, after you and I discussed what topics we'll be talking about today, I have done some research. There would be some lenders, and always rule of thumb, under 80% is always the space you really want to be in. So one lender I spoke to definitely said that would fall into our commercial.
Yeah.
Another lender I spoke to said not necessarily, because some people build 5-bedroom, 5-bathroom homes. However, they would take the rent off the valuation.
Yeah.
So if the rent on the valuation is $1,000 a week, but the client's going to do what they're going to do and rent it out individually and get $2,000 a week, the bank will service it on the $1,000. So it's not really a hard and fast rule. It depends on the different lender, where the property is, and sometimes it comes back to the comments of the valuer.
Right, okay. And if it does, then if it's deemed commercial, what you're looking at is a larger deposit?
There are lenders with options to 80%.
Oh, wow, for commercial.
There are. Not as many these days, but yes, because even though it's commercial, it's not like your commercial, like your commercial property in terms of a shed. Like it is still, it's kind of residential. It's a residential security, but its use is commercial. So potentially you could go to 80% on that.
Yeah, okay. And commercial loans generally have a higher interest rate, is that correct?
Yes, they do. That's just a factor. And you've got rates around the 5s to 7, depending, and it depends if it's low doc or if it's full doc. Like there's so many variables. So rates is something that it's not like years ago where everyone was pretty much the same. There are very different rates. And then, of course, you've got some of your private lenders that may fund it. They may fund it for 12 months if you've got you've got an exit strategy. So, you know, why do we need the money? Why are we going private? Okay, we're getting out in 12 months, and there's our exit strategy. And I think for investors, as I've always said, you do your sums when you buy the property. So you obviously need to know at the start what it's going to make you at the end. Is it a long-term hold? Is it a build and sell? You know, what is it? What's the purpose? So you're doing your numbers, and yes, you might be paying, say, 6%. Just throw that out there. I don't know. And you're thinking, oh, but I can get 3.5 over here, resi. But if you can't get it at resi, then are you still missing out on a good deal because you might pay 6% for 12 months?
Yeah. So there's the opportunity then to refinance, is what?
Yeah, of course.
Yep. And I guess if you've got by then traction or showing that you're yielding really high, showing that you've met all your repayments, would that make it an easier story for you to then take that out to another lender?
Well, if you've got poor history, that makes it hard anyway for any to refinance. But I just guess it depends also on the lender's appetite at the time.
Right, okay. Because I know with these multi-occupancies, what Rick was saying, Rick Stapleton was my guest last week, he was talking about the fact is you could turn it into a residential. These multi-occupancy buildings are in residential areas, and there's nothing really to change apart from maybe the locks on the bedroom doors, and maybe if the bedroom doors have a number on them or something like that. But for all intents and purposes, 5-bedroom house with 5 en-suites.
Well, and that's what I mean. And that's what the discussion I had with one of my lenders. He said, well, some people would build that, you know, for their own home. There's a lot of blended families. A lot of people like space, or they have mum and dad and teenagers. So really, it wouldn't be unusual to have a 5-bedroom home with 5 bathrooms.
I couldn't think anything worse.
I couldn't either. You'd have to have about 5 cleaners, wouldn't you? Like, seriously.
Look, I mean, I've got a big family. I would love to have a big, beautiful home in that sense. I'm not worried about. But I did go through an open home not that long ago, and every bedroom, it was a display room, had a bathroom, and I was thinking, man, if you've got 3 kids, that's a lot of bathrooms to chase around.
And dare I say it, 3 boys, Jo.
I know.
You know, 3 bathrooms to clean with 3 boys. No thanks.
I'll be picking up towels for months. So here's a scenario. Okay. So I guess on the back of those sort of obscure lending stories like the multi-ocs and all the rest for investors, I can see all these questions popping up, so I will save the questions. We'll wrap up, and then we'll get onto those.
Okay, yeah, sure. Hopefully I can answer them.
Yeah, I don't doubt it. Okay, so if you have a property worth $1 million,
yes,
valued $1 million, a $400,000 mortgage. If you wanted to subdivide the land that you're on, so it's just say it ticks all the boxes, you can subdivide that. Okay, so I guess the question is, if you were to subdivide the land, how do you fund the subdivision? Now, a subdivision can be 70 to 90, sometimes even more, like 90,000, right?
Yes. I
understand you can get the equity out of your property, but can you get the equity out of your property to do a subdivision? Is that an approved process?
Not necessarily. Short answer is probably no. So, but the way you could go around it, so when mainstream or majority of lenders, if you're doing a subdivision, you have to fund it yourself, because today we're working on a property, say, worth $1 million, and then in 2 weeks, in time to come, it's going to be RP data 1 and 2. So now you're going to have 2 properties. Okay. However, if you've got, in this perfect scenario, $400,000 against $1 million, and you needed $100,000, you could take it as cash out. Then you could go and do the subdivision and come back. Now that bank may not want to do the subdivision, which you may know that already, so you go to lender B. Okay. And then you say, okay, we've now subdivided, we've got our property from 1 to 2, it's now worth 1.5, we're going to split them off. We want to spend $100,000 renovating the first home, because there's nothing wrong with it. In a perfect world, it sits on the block. The second block, we're going to build the home, so we need the funds for that. So there is a way around it. You know, you've just got to work out how you mitigate getting that cash out with lender A.
Yeah.
Because majority of lenders, you do need to fund the DA yourself.
It's a lot of money to come up
Yes. So, you know, these are, you know, when people want to do this type of stuff and, you know, there's money to be made in it, don't get me wrong, but you really have to have your plan.
Yeah,
You
sure.
really have to have your strategy and your plan and your timelines, because if you can't fund the DA, it could just be a money pit, unfortunately.
Right. Now, I spoke to a lady earlier today, and I know she said she was going to be tuning in. So I'll ask her scenario. She's looking to buy 3 lots on one title.
Yes.
And on 2 of those titles, the house straddles it. And so I was saying to her, perhaps she could look at funding the subdivision of 1, and then she could sell the land off, which will put
But
money.
she's got three lots on one title.
Yeah, but currently there's an existing house that straddles 2 of those lots.
2. So the title that's the title that's 3 on its own, are you saying yes, she could sell that off?
Yeah, and then she could
use that money to do the subdivision and move the house. Correct.
Yeah.
That because then she's got her own cash.
Yes. So that's what I was sort of saying, like maybe this is the formula she needs to work with. So as opposed to needing the funds for the entire project at once, she just takes
it. You might have to do it in a process. Yeah.
So working with a mortgage broker like yourself, you would sit down with somebody and sort of go, okay, that's your strategy. Let's do this now. Let's revisit that when you've sold, and you would work with that client through that.
Correct. Yeah. So we don't just go, oh, here, we got you in, see you later. Like if there's a, you know, well, after 21 years, I have clients that I work with continuously. And, you know, and I have a team behind me. So I'm really fortunate that we've got a business that has been sustainable to work with people. And as I say to my clients, this is the plan and this is the goal, and we're doing this. This is what I want to do in this lady's situation. We're going to buy this property. We're going to sell off lot 1, and then lot 2 and 3, when I get the money, I'm going to move the house across or demolish, whatever it may be. Yeah. So you need to maybe have a clear plan, or I would suggest up front. But there's always, in what's called life, sometimes things change, something may happen. So then we need to have, well, okay, what's plan B?
Yeah.
But if you know your strategy at the start, that is when you make your money.
Yes, yes. And that's what I said, you know, have an exit strategy in the event that it became too, I don't know, labour intensive, overwhelming. Perhaps, you know, she then gets the DA and renovates the house and sells that as a package, as opposed to actually doing it herself, which a lot of people make really good money from just paper shuffles, you know.
Correct, because you're selling the potential.
Yeah.
So you've kind of, you know, you've sort of done some of the hard work, because it may be in this case and we don't know, but selling off block 1 and the money I'm going to take, I'm going to move the house onto lot 2, and then lot 3 is on its own. So someone can come on and go, oh, well, that's all been done. I can now purchase it and build the house. And the person, the first lady's probably made all her profit anyway.
Yeah, that'd be great. So I guess in a buying entity, so if I come to make a purchase and I'm an investor and I'm Joe Vadillo coming to you for a loan, is there any justification? You're still liable if I come to you as Property Women Proprietary Limited buying a signed contract.
If you buy in a company or trust, it can be for asset protection.
Yes.
So if you're buying in a company or trust and you're self-employed, a lot of self-employed people do set up for that reason, because then it you know, it's not you, Joe Vadillo, but you are still guaranteeing the loan because you are the person. Yeah. And the company at this stage, if it's brand new, it's got no income. Majority of lenders won't lend to trading companies as such. They'll lend to like a property trust. But setting up companies and trusts, and I've come across this a lot recently, really do your research on why. Because if you're Joe Vadillo, a PAYG employee, and you're setting up a company or trust for asset protection or because you've got tax benefit, you don't have any tax benefits. They sit in that company or trust.
Right, okay.
They're not given to you. So, you know, I would always, you know, I'm not going to give it tax advice or financial planning advice, but always make sure you get that advice from a trusted source.
Sure, of course, yeah. And even though I am me and my company's me, my behaviour is what the banks are going to look at.
Correct. Because where are we getting our income from? Like, even though, because I've had clients come to me saying, oh, no, you don't need my income. I've been told that it's the company buying it. Yes, but you're the company, like, you know.
There's no money.
You know what I mean? Yeah. So you have to still guarantee that debt. And then if you guarantee that debt and you go to buy property B, we have to disclose that you're a guarantor on that debt.
Yeah, wow. Okay.
Okay. So, you know, I'm just letting you know that there is so many variables, I guess, is what I'm trying to say.
Yeah, of course.
It's really not one shoe fits all.
Yeah, and you know, since we've been talking, I'm thinking you must do so much homework per client. Like they must, I know there's software to assist and all the rest, but you must, it still comes down to humans looking at something and going, right, how do we make this work for this person?
And, you're 100% right, because obviously with a lot of new technology and everything and blockchain and all the different types of ways of borrowing, and one of your ladies asked about homeloans.com, and that'll lead me to that. As much as we all go on Dr. Google and love it, it's our best friend, and we want to know everything we can, people still do like to deal with a human, because there is so many different parts. And I always use the analogy of, if I was going to buy a loaf of bread, I don't need the advice on how to do that. But if I'm going to buy a home or a massive, it's a big purchase, whether it's my dream home, my first home, my, renovator's delight, you want to make sure that you've got someone that you can pick up the phone and talk to and ask 100 questions, because there is so many different variables. Now, homeloans.com, they are funded by First Mac. So First Mac are a bank. Their head office is in Brisbane, but they're an online. So you are going online and doing your finance online. So nothing wrong with that if that's the sort of person you are, that you can do it all online and manage it yourself. But in my experience, we like to have all that online access and do all our research, but we still do want to have a person at the end of it that we can go, oh my God, or I just had a client today say, now look, remember all those numbers we worked out? Did I borrow enough? Because we sold for so but I just think human interaction we're never going to lose that. We still need that.
Yeah. Well, they're leveraging off, like you said, 21 years of experience as well. And it's, you'd have relationship with the BDMs at the banks.
Correct.
I know there's rules and regulations and there's black and white, but it does come down to the networks and human contacts and the relationships and what doors you open and how readily your phone gets picked up versus. So I'll just read the question out that did come from Kylie. She just wanted to know your opinion on the lenders, such as you mentioned, homeloans.com or loans.com and reduced home loans. Are they a trustworthy? Are they a trustworthy option, really? And a lot of mortgage brokers don't have them on their panels
because they're direct. So they're their own. They're like their own. It's like National Bank bought out So it's an online bank. It's just another way of getting their funding out. Right. But I have First Mac on my panel, so I can write with First Mac, but not their online portal.
Yeah, okay.
On their online lender. So it's just a different way of, a lot of lenders wholesale their funds. They're just wholesaling it through an online platform. Yeah. So with that online platform, you do speak to somebody, but it's all done online.
Right.
And banks in Australia are one of the highest regulated banks in the world.
Okay.
So like going back, talking about, are they safe? Yes, they're safe. They have to meet so many compliance responsibilities. They've just gone through Cedric reviews. A lot of the banks have ASIC and APRA in their banks, basically have offices in there now. So we are one of the highest regulated lending institutions in the world.
Yeah, right. Wow. So I'll go to another question we have pop up from Susan. What kind of access do lenders have to your other lenders' accounts or transaction lists? If we use a travel card, does that need to be disclosed for a month-long holiday, for example?
Okay, so just with the travel card, it is a credit card. So if it's a credit card, if it's a credit card, yes, because it's got a limit. If it's a debit card, no, because you're using your own money. So anything that's credit that you can buy now, pay later, 100% you have to disclose. But a lot of people have Visa debits these days. The money's in the bank.
Are you seeing that more and more?
Which one? Sorry.
Debit cards. Are you seeing more and more?
Yeah, a lot of people use Visa debit. And because credit cards, unless you can manage them, the interest is at nearly 30%.
Yeah, and I've noticed more and more you're getting stung. Oh, you can pay, but that's 1.5. And when I'm, especially from a business point of view, like I'm, sometimes my costs are thousands. And you're like, oh, yes, that's nothing. And then you go, actually, it does kind of add up.
Yeah, because, a lot of them now pass on the 1.5 fee that they get charged, to have the credit card. So you're right in that respect. Is that what you mean in that respect?
Yeah. Like that's even just your ground level Visa, MasterCard.
100%. And I'm thinking, I agree with you. But yes, I think a lot more people, we seem to be turning a bit different. And I couldn't even say really it's different demographics in age, but there are people more so using cash and direct debit these days. I speak to a lot of clients now who don't even have a credit card. I'd say they have, but they're like, you know what, we just don't have them anymore.
Do you think that when you mention the word age, is it more of a millennial thing that they've been educated away from living on credit, or is that?
Yeah, Jo, you know what? I think it's individuals, and I also think sometimes it is learned behaviour. So what did mum and dad do? Not all the time, but I'm just saying, it's what mum and dad did. Particularly young buyers, first-time buyers will follow in mum and dad's footsteps and go to Bank A because that's where they went.
Yeah.
But it's interesting because sometimes the younger people, they want it all now and pay later. So I can't really say, to be honest, if I don't have statistics on it, but I don't really think it is an age demographic. I just think it's people's individual spending habits and their behaviours.
We all, I mean, everybody is, our money and our habits are learned from childhood. Watching parents fight over money, being told to eat all your food because Africans are starving, and all the things that I was raised with. Or, my grandmother's generation, she was a child during the Great Depression. So she did at the end of her life, like there was not hoarding, as in like, not like she, you couldn't walk down the corridor hoarding, but she kept a lot of things, things that we're more of a minimalist society now, where there's definitely a trend to declutter and all the rest. But she had the good china that was maybe used at Christmas, whereas I'm now, it's Tuesday, let's just use it.
And I agree with you. I think we have changed. Like, I use the good, if I'm having champagne, I get my best glasses out. Like, it wasn't years ago, it was, it's for best. Or, well, what is best? We're off topic a bit, but every day should be the best day. We're here, so enjoy it. And we work hard. Like, I think as generations have gone on, we are spending a lot more time at work. We are spending a lot more time working to have the lifestyle we want. So we should enjoy it. But obviously, when you want to get a home loan, just watch those living expenses.
Of course. Yeah, but the learned thing from parents, and I know there's also this big movement. I know there's been Barefoot Investor's book being like #1 bestseller forever, but he's very much a debit card person, but he's also not particularly property centric. So thanks for that. But
look, you've got to do your research. As I say to all clients, there is so much available, and Dr. Google's your best friend. We need to do research. So, I have a lot of clients many years ago when I first started, people didn't do any of that. They were recommended to you and they just, great, I'll use you. And I still do obviously get a lot of referral business, which is how it predominantly works. But, we should do our research to have our eyes opened into what's going on and what's what. We don't have to have all the answers, but feel comfortable with the people you're using. So if you wanted to use my service and I don't know the answer, I will find out. I'm not just going to tell you something so that, you'll use me. I need to make sure, because it's a really important part of your life. The journey of property is a big part of your life. The finance piece, as I always say, is not sexy, but what it can give you, the joy of having your own home or getting into your first investment or upgrading or downsizing, or if you've had really financial hardship, you may have come out of a divorce and never thought you could get your own home on your own. They're just massive, opportunities. And so work with people that get how important it is to you, if I could say that. That's what I think anyway.
Yeah, and look, I've seen people who've come to our services to help them buy property, and the advice they've been given from a broker or the structure that's being set up is just not right. It has, and that poor, I guess, professional management of their finances can actually set people back.
Yes, it can. I've seen it too from other brokers and accountants or planners, and I'm just, just in general, and I'm not saying, we all make mistakes, we're all human, but we really just want to understand exactly what the goal is. So if you're going to be speaking to somebody, need to know, well, this is what I want to do. This is what I want to do now. This is my 3-part plan. And make sure you're set up correctly, because it's no good buying the property now in your name and then putting it into a trust later.
Yeah,
but circumstances change as well, so you may need to, but be aware that you will pay the trust will pay stamp duty to transfer it.
Of course, yeah, and that can be substantial.
It can be costly depending on the state and where you are. So it's just really all about understanding what it is you want to do with the property.
Yeah, absolutely. So I've got a question from Raquel. She's just asked, if I have $250,000 equity in my house, how much of that can I use to buy a new investment property? I was told just 60%.
No, well, you can, if she's got 200,000 equity out of that 200,000, you can go up to 90% if you wanted to, but you'll pay mortgage insurance. So to keep you out of mortgage insurance, if you wanted to borrow 80%, you could borrow 80% of that, which would be $160,000.
Wow, okay.
If the equity is 200 over and above the loan, so that so 80% no mortgage insurance, but you can go up to 90% against your principal place of residence. I just did mine I just bought my sister out of a home. So as you know, I've been through a divorce and didn't end up with any property. Back into the market. Yes, it was costly, but I own my own home at 90% and I capped the mortgage insurance. Wow. However, I have a strategy and there was a reason why I did that.
Yeah, sure.
So you can go to 90 plus cap the LMI.
Yeah.
If you want to you don't want to spend that money, keep it at 80%.
Yeah, absolutely. And look, I see where LMI can come into play. It gets you into a property. Yes, there's a cost attributed to that, but sometimes it's not a bad.
For me, I would never have saved enough to bridge that gap.
Yeah.
When I could buy now, and my property will go up in value. So once again, it was about me doing my numbers. What's my long-term goal?
And I think a lot of our community members I know have come through broken marriage scenarios where they might be still the primary caregiver of their children. They might be in part-time work. It's just about, LMI, the cost of that insurance is a necessity sometimes too. And the amount of confidence it gives you getting back on the property ladder is amazing, isn't it?
I know. Look, it really is. I mean, my sister and I, we demolished a house. So I've been down that path. We demolished, we built a brand new home. We were going to sell it. Didn't quite work out, but I think it's actually worked out exactly how it should have. I own a brand new Hampton style home and I bought her out. At the time I had income, but I didn't have enough deposit.
Yeah.
So, I did a JV with my sister and she helped me get back into the market. So some of us that have been on our own think, oh my God, I'll never get back in, but there may be a solution. And fortunately I had a sister that was willing to work with me on that. But I settled 3 weeks ago and I can tell you, it is an amazing feeling to own my own home all by myself. I'm such a growing up, Jo.
Yeah. No, that's awesome. And it's an amazing achievement. I think, and people are scared coming out of the financial, I guess, ruin that divorce can leave you in. So they go, I'm going to put myself back out there, like going back out dating, it's a big step.
Oh, yeah. It's
one of those
pretty similar.
Yeah.
Yes, go on.
I do have another question I want to ask you, and I'll just let everyone know that we've got to wrap up now on time. We've got about 5 more minutes left. Okay. So if you do have any questions for Tracy, pop them in the chat box. You can, I think there's an opportunity there. You can say just to the panelists or to all attendees. So if you want to remain confidential, there's also a Q&A box there as well. So with the RBA rate reductions,
yes.
What's the best rates at the moment? Like what can we expect as a resi investment?
Okay. So you're talking investment, and I just did some research for a client. Now he's an 80% client and principal and interest. Mm-hmm. And I can get him 364, seems to be the best rate going around between under 80, under 60, 359. So that's on principal and interest.
Yeah.
On interest only, you are going to pay for high threes, low fours.
Okay.
And rates are different. There's a few variables. They're not massively different, but there are a few variables with different lenders. Okay. And principal and interest investment, you'll get a better rate than interest only investment. Okay. If you're looking at getting into your first home, now there are a couple of lenders out there that are or your own home, I should say, they're offering 2.99 fixed for 3 years, which, look, Jo, great rate. But let me tell you, you got to be in the box borrower. Everything's got to be very Mickey Mouse in the box, and you will have to provide a lot of information. So when you feel like you have provided your firstborn and kidney with it, when I tell you it's like that. However, you will get the rate. So it's a trade, it's a trade-off. They are very clean in the box sort of deals. So once again, rates are really topical at the moment with the Reserve Bank dropping. They didn't drop this week, so the Reserve Bank stayed where at 1%. I kind of think that's a good thing, and I might get a bit of pushback on that, but we need some stability. We need to understand where our market's going.
Yeah.
That's just my opinion. At rates being at 3.5% and 3%, I think that, it is a good time to be buying, but obviously be mindful that you have to meet that repayment if rates go up.
Yeah, sure. Edwina has asked about self-managed super fund loans. Mm-hmm. And what do they look like now for interest?
Okay, a lot of lenders did get out of the market. Majority of lenders did. We still do have a few. They will lend to commercial and resi.
Yes.
Majority of them have liquidity testing. One of them, you've got to have $250,000 in the fund. Some of them don't have that high. So short answer, Edwina, is yes, it's still available. 80% is where it caps out. But you really would want to speak to a broker about that, because the lenders like your AMP, St. George, all the majors that were doing SMSF lending are out of that space.
Yeah.
It's now more your specialist lenders.
Okay.
So they are still available.
But what sort of interest rates?
I knew you'd ask me that. I just did one. It was 5.59.
Okay.
So look, it's not too bad, but it is specialist, it is SMSF, and because there's only about 4 lenders still doing it, they kind of, it's all risk for rate.
Okay. Yeah.
And with your SMSF lending, Jo, just one thing I will mention is the fund services the debt. So what I mean by that is Jo Vadillo buying in her SMSF, we don't take in any of Jo Vadillo's personal expenses, liabilities, or assets. We look at your whole picture, but the fund, so if you've got rent of say 50 grand a year and you've got super contributions of 20 grand a year, as long as that services the debt, that's what they need. Okay. So it's a limited recourse lending. So it's only based on what's in that super fund.
Gotcha.
What the expense is for that loan is all that's used for the assessment.
Awesome. Okay. So thank you for today. I do appreciate it. And I know we've had some big questions just to throw at you.
I know, thanks.
Tracy's going to be presenting next Sunday for those of you who are coming along for our Brisbane Conference. So that's exciting. Get to see you.
I know, you'll see me in person for those that are going to be there. And obviously there'll be a lot more topical questions, I'm guessing. And I hope that, all of you ladies and gentlemen have enjoyed today. As you can tell, I am quite passionate about what I do. And it's not until someone like you, Jo, starts asking me questions where I go, oh, I do know that answer. So, obviously my research is working. But thank you for the opportunity. And I do hope that what we've discussed today maybe has just assisted somebody with what they want to do. And, whether it's with me or not, but just make sure, I can't stress enough that you do have the right people working with you.
Absolutely.
Yeah.
And if anyone wants to get in contact with you, what's the best way of doing so?
Well, my website is Home Loan Connexion, and CONNEXION.com.au, or you can Google me, and I'm on LinkedIn, I'm on Facebook, and my phone number is 041 7738 469. Or they can come through you, Jo, as always.
Yes, of course, yeah. So if you did want an introduction, by all means, come through me. Just respond to one of the Property Women emails, and I'll be able to drop an intro then, and you can take over from that. Looking forward to seeing you in Brisbane for our conference.
Me too, and I'll be another year older.
I know, it's your birthday.
I know, thanks for that. That's all
Nothing
right.
like a Sunday morning presentation the night after your
I'll behave. Don't worry, I'll be behaving.
Watch Netflix and go to bed at 10.
That's right. Said no one ever.
Exactly. All right, everyone. Thank you.
Thank you for having me. I'll talk soon. See you next week. Bye.
Ciao.